Hello everyone, welcome to Ruby's channel. Today I would like to discuss 3 valuation approaches commonly used for business valuation. They are income approach, market approach, and the cost approach. Let's talk about income approach first. The income approach determines the value of a business by converting its future cash flows, including the income, cost or cost savings, to a single present value. So the most commonly used method under the income approach is the famous DCF method, discounted cash flow method. I think a lot of you have either heard, seen, or used this method. What this one's doing is to using the business future cash flows discounted back to today's value, the present value, by using the business cost of capital. So we'll talk about the DCF method and what is the appropriate discount rate a little bit further in the future videos. The second approach is the market approach. The market approach is basically applying when the target business we are trying to value have a similar business recently been sold in a transaction, or the similar companies are actively publicly traded in the stock market. And those information are available, especially price information, then we can use those comparable transaction price information or comparable listed companies' market value or market price to help us determine the value of the business we are trying to value. So the market approach, the method under market approach is the comparable method. And the comparable method, we normally look at the comparable transactions. Basically, if a similar business recently been sold in a transaction that we have the price information available, or the publicly traded comparable companies. So we see the stock market have some listed companies share the similar characteristics to the business we are trying to value, and then we can get the market price and the other information such as revenue growth, EBITDA multiple, EBITDA growth, etc. to help us determine the value for the business we are trying to value. The biggest downside for the comparable method is the information. Especially for transaction, it is very difficult to get a price information from the recently happened transactions, because none of those information is publicly available, and a lot of them are quite private, confidential information. Again, we will also talk about the comparable method in more detail in a future video as well. The last approach I want to introduce today is the cost approach. Cost approach you can more see in the valuation of physical assets instead of the business as a whole. But the concept for cost approach is provides an indication of the value based on the economic principle that no one will pay more than the cost to obtain an asset of equal utility or purchase a similar asset from a different buyer. So based on that concept, we have two methods commonly seen under cost approach being used by the valuation practitioners: replacement cost method and the reproduction cost method. Replacement cost method basically is we are looking at how much we need to pay to get a similar asset with the equal utility from the market. Basically, how much we need to spend to replace the asset. Reproduction cost method is basically considering how much cost we need to spend to buy to recreate the asset, say construct the asset from scratch. So basically, that is the reproduction cost method. As you can see, all the methods under cost approach are looking from cost perspective about how much cost we need to spend to recreate or reproduce the assets. Okay, so this is today's video. I just want to quickly give you a high-level understanding of the commonly used valuation approaches and the methods under each of them. As I mentioned before, I'll talk each of them in a little bit more detail in the future videos. If you like my video, please click like and also don't forget to subscribe. Thank you for listening.